Welcome to the Dividend Talk podcast, episode number 12, How to Value Growth Stocks with Investment Talk. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to the channel, please hit the like button and subscribe to us. And also check out our previous episodes on YouTube and Spotify and all your other favourite platforms. See you on the inside. Welcome back to another episode of the Dividend Talk, guys. I'm joined here today with European DGI as always, but I'm also excited because we have a guest on called Investment Talk. I'm sure some of you will know him from Twitter, but I won't go on too much about it. I'll just ask him himself. How's he doing? How are you doing, Investment Talk?
I'm very good, guys. Thank you for having me here today. Really excited.
Yeah, no, it's great, and we've been wanting to have you on for a while, so we're both delighted that you could join us.
Yeah.
Just to get started, can you just tell us a little bit about yourself for those that may not know you?
Sure. So a lot of you may know me from my Investment Talk Twitter page. So I'll cover a bit of context into kind of how I got into investing and the Twitter page as well. So I started investing around 5 or 6 years ago now, mainly during university. I was an economics grad, and then I went on to kind of study innovation as a master's. But during economics undergrad, that was the topic I was really interested in at first, the kind of broader business landscape and how trade works and the kind of psychological factors to do with microeconomics. And during that undergrad, we had a few topics on corporate finance. We never really covered investing to too great an extent. It was more so the structure of corporations. And that was something that really pinged with me, more so than economics. I still love economics, but the investment side was something that really interested me. So from that point, I would have been maybe 19 at the time, started reading and consuming all kind of books, a lot of the classic ones, more value orientated. The Intelligent Investor was the first book I picked up. Read it through, didn't really understand it to the fullest extent, but I read it a few times more after that, now understanding it better. So I really resonated with kind of Ben Graham and Philip Fisher because they kind of simplified the investing process, and I thought, this is something that I could do. So I kept doing that all the way through my studies, and then when I graduated, actually during my master's, I started enrolling in the CFA, the Chartered Financial Analyst designation, for those that don't know. And that really accelerated and just kind of poured lighter fluid on my abilities, I feel, because the books I was reading didn't really get too granular and technical into, how to discount cash flows, what are equity risk premiums, how can you distinguish between a mature and a growth company or one that pays a dividend. So that was something that really kind of increased my analytical ability there. Something that I was super happy that I did. And then eventually when I graduated and stuff, went into the corporate world where I'm now an analyst based in Scotland. And to the point where a lot of you probably know me now, back in February this year, I started a small blog just before the Corona lockdown kind of happened. And just kind of as a byproduct of the lockdown and the environment which I was working in from home every day, I had a lot of free time to kind of focus on this blog and interact with people and get it growing. And it's led me to this point now where I've published a few guides, write a daily newsletter to subscribers every day, and it's something that I really enjoy. And hopefully, given enough time, it will replace my current job, but we still have a long way to go before that. Fast forward, I'm now sat here with you two guys on the podcast, and looking forward to the discussion today.
What I can say is I'm really happy because sometimes we're having a small rant, EMF and I, around let's say the Twitter accounts and such, and I really got inspired by your tweets. But I loved it even more that you're not fooling anyone with your content. So it's just really my kudos there to you, because you really intrigued me with one of your replies that I felt like, finally a no nonsense guy. Not a person that's creating kind of a semi Ponzi scheme, but just really honest to his followers. And I'm really, for me, that's really good to see. Thanks for that.
I really appreciate that. Thank you.
So having said that, what we usually do when we have a guest on the show, we do a few rapid fire questions.
Yeah.
And I've got 5 questions prepared for you.
I'm ready.
It's optional. You just choose one, and in the end, you can get to clarify 1 or 2 of your answers.
Cool.
Ready?
Yeah.
Okay. Which color do you prefer, green or red?
Red.
Scotland being a part of the European Union without England, or together with England out of the European Union?
Together with England out of the European Union.
Man United or Chelsea?
Chelsea.
British American Tobacco or Royal Dutch Shell?
Royal Dutch Shell.
And then the last question is more about films. Braveheart or Macbeth from 1971?
Macbeth.
How can you not pick Braveheart?
I've actually not seen Braveheart. I know that sounds terrible, but I've not seen it.
Well,
but
it's
I
maybe something for the
studied Macbeth, the play, so I just chose the one that I'm more familiar with.
Yeah,
brilliant.
Is there any question you would like to clarify or any answer?
I mean, I was actually discussing this with a few buddies last night. The one about the Scotland still being outside of the EU, but also being as a part of the United Kingdom. That's not like a belief that I'm super like. Politics is an interest to me, but it's not something that I'm always pretty open. I wouldn't say I have any kind of left or right leaning side. I prefer to just like listen to the facts. I personally don't think Scotland would be in a beneficial position to kind of be on its own and then try and make ties with Europe. So kind of the instinct was just stay in the UK, see how Brexit happens. I was originally, back in the day, Remainer. I voted Remain. Now I'm a bit unsure. I feel like the UK could do pretty well on their own. But then you have all these things like free movement, which is a great thing in the EU. But my decision more stems from the EU in general. The EU is super good. Like I love the whole principle of it, but it's kind of a flawed system. You have one central bank setting rates for countries like Greece, and then you have countries like France. One of them might want a high interest rate, one of them might need a low interest rate. Then you have that whole single currency. But from a trade union perspective, pretty good. Free movement, really good. But yeah, that was just kind of a gut instinct to just say stay with the UK.
Yeah, I think it'd make more sense for you guys. Like we see it on this island, we have obviously Northern Ireland and Ireland.
Yeah,
there's huge problems, and free movement is obviously going to be one of them, and how we control and manage that. So I would not envisage that Scotland or Wales or England, for that matter, would want the same hardship, I suppose, on that island. So I'd agree with you in your case.
That's fair.
It's just a really complex situation. I wouldn't really know what to answer, so I have it easy.
It's a difficult one because in politics, some people are just really, really like battened down to their own kind of ideology. So you just have polarizing views. I think it's less like that here in the UK than it is maybe in America, but it's still quite a topical issue.
Yeah.
Same with Scottish independence. That's another topical issue.
Yeah.
But yeah.
Cool.
So we'll move on to a slightly less heavy subject. We usually at this point we look at kind of something in the news that kind of sticks out for us, and I don't want to put you on the hop, so I don't know if you have something, but EDGI, is there something that stood out for you this week?
Well, yeah. how is it? I think it's called. I'm trying to translate it because it was in the Dutch news, but the Dutch governance body of health did a research about the impact of 5G, and it's effectively saying now, like to the telecom providers, you can continue investing in and rolling out your 5G network because it's not proven that it creates health issues, but they were neither able to, I said, fully exclude that there won't be any health issues. So they need to really do it with care. And I find this really intriguing because just when I look around me, I live in a quite forest kind of area, and I just see the bees and the insects disappearing over time. I don't know why, if it's just climate change, but something in my gut feel always says like, 10 times more Wi-Fi signals here, all these microwaves going. And I know a little bit about, I say it, how to operate a mobile network, 3G, 4G, and the distance between the antennas, let's say for 5G, is really close to each other. So there will be much more concentration of airwaves going on. And I just can't imagine that this will come without any consequences to the nature that we live in. So I found this really interesting from a news point of view.
Yeah, that's something quite interesting. Yeah.
Yeah, 5G, it's a tough one, and there's lots of research on both sides, and I've done a bit on it myself. But as an investor, I'm kind of caught on it because I am heavily invested in some companies that will rely on this 5G, and their growth is potentially going to come from this 5G. So, like on one hand, you have maybe it will cause health issues, and on the other hand, well, I might get wealthy if it takes off. So it's certainly a battle of ethics at the moment.
That's where, for instance, I'm not sure about AT&T and as an example in the 5G play. I think Apple will benefit much more from it with their services in the mobile app library. Imagine what 5G can do into the whole ecosystem there. But if you look at what 4G had an impact to the operators, they're still a utility. They're still fully loaded with debt. The investments that they make, I think other companies will benefit from that. Companies that we don't know yet today, even that are able to leverage 5G and innovate on such an infrastructure.
Mm. Yeah. And interesting you mentioned Apple there, because they stood out for me this week because they're building a wind farm. I think it's one of the world's largest wind farms in Denmark, which is really, I suppose, from an Irish point of view, a little bit disappointing because they wanted to have this data center in the west of Ireland, but it was bureaucracy, but there was planning permission that held up for years and stuff that eventually Apple just kind of went, do you know what, we're taking this 850 million investment somewhere else. They brought that over to Denmark. So it's quite, look, I'm happy for Denmark. They're getting the benefits of this, but from an Irish perspective, it's kind of, I wish we were a bit more on the forefront and able to go ahead and like Galway, like you won't know the infrastructure of Ireland too well, but the west is pretty much not as vibrant as say Dublin. It's on the opposite side. Now Galway is quite good, but this would have benefited them massively. So a little bit disappointing, but it's kind of why it stood out for me this week, I suppose.
Cool. Okay, so I think we could talk an hour longer about all the news that's happening because cucumber season has finished. But let's go to the main topic of today and talk a bit more about growth investing. I think it's fair to say EMF that for us, it's probably our weak spot because we're brainwashed and really in the mindset of dividend growth investing. I did write a blog post this week about Microsoft, but it's still more like with a dividend growth investment mindset written and value investments, but not as growth. Yeah.
It's something I'm asked all the time, and I'm sure you are as well. And why dividend investing and why not growth? And I always say the same thing: dividend investing, it matches me and my risk and my personality, but I don't know enough about growth investing. So I'm here to obviously educate myself and maybe learn from that and start small. I don't jump in. So that's why I'm kind of excited here. And Investment Talk, you're the expert today, so we're going to pick your brains and hopefully learn something new.
Sure.
So Yeah, I just wanted to understand first, as a first question, maybe, what means growth investing for you?
So I was going to discuss this in kind of a more holistic way, because there's many different ways that you can categorize a growth company or a growth investment. And there's no kind of hammer to the nail. There's no specific one. I've discussed quite a few times in my Twitter feed the kind of cycle that companies will go through. You initially have kind of startup companies that are just basically idea-based companies. And these will typically be private companies. And then once they get through the weeds and that niche offering that they've kind of offered gets a bit more traction, they may go public. And this is kind of the next stage is the classic kind of quote unquote growth company that a lot of people are investing in now. So by this stage, they've had more adoption. Their operating history is still fairly limited. There are some comparable firms in the industry, but there's no really any mature companies that are comparable. They might be a disruptor, take Square, for example, or you have like the Livongo, Teladoc merger. There are certainly companies offering what they're doing, maybe not to the extent that they are. They might be more mature. But when you get this growth kind of company, there's a few different ways that people will tend to categorize them in the analyst field. And one is sector-based. So US tech, for example, is typically slapped the label of being growth. But then you have to remember that within that tech field, there are mature companies that have been around for 3 decades. There are companies that just formed 5 years ago, whose revenues are growing, 50 to 100% every year. Then you've got Apple, for example. I wouldn't say they're quite mature and declining just yet. They might be in the early stages of maturity, but they're an innovative company. But their revenue growth is nowhere near the extent of some of the smaller companies in that space. So the disadvantage of just calling tech growth companies is that you're not really differentiating between the business cycle, because you'll have some younger growth, you have some mature, you might even have some that are declining. So a second way you kind of categorize a growth company or a growth stock is through analyst estimates. So if you take a look at the analyst estimates based on the next quarter or the next year, or even 2, 3, 5 years out, if they are above a certain percentage, if the general consensus is that company X is going to be growing its revenues by 50%, or their earnings are going to double over 3 years, you could typically slap a growth label on that. But the downside to this is that analyst estimates typically focus on earnings as opposed to the top line. So, and the thing is with most growth companies, how they tend to be categorized on money Twitter anyway, is that the earnings are typically pretty bad. They might not have free cash flow, they might have negative earnings, but they might also have a top line revenue that's growing 100% every year. So categorizing them in this way has its downsides as well. And then you also have, lastly, market-based measures. And by this, I mean, your ratios, your price to sales, price to book, price to earnings. So you'll be basing your assumption of whether it's a growth company if the multiples are higher, because the rationale is if this company's multiples are higher, then investors are willing to pay more for the revenues. If we take price to sales, for example, if you have Apple trading at 25 times sales, for example, I don't know if that's correct, just pulling that figure out of my head, everyone's paying $25 per dollar of revenues. Whereas if you have a CrowdStrike that's at 50, everyone's paying $50 per $1 of revenue. So the assumption is the market is pricing these companies correctly. The market is efficient. So we can take what the market says and buy these growth companies. But as I just said, the biggest downfall to that argument is that you're assuming the market is pricing these companies correctly. And whilst you may believe in efficient market theory, if your listeners are kind of familiar with that concept, I personally don't believe the market is efficient every single day. Just very briefly, for any listeners that have maybe not heard of this before, there are 3 kind of broad kind of schools of thought about efficient markets. You can have kind of on the lower end of the scale, where they might reflect public information in the share price, but it might, be delayed. And this is typically what you see in developing economies, where the information is there, but it takes a period of time before the market reacts. And then you have kind of semi-strong efficiency, which is where all public information is known and reflected pretty quickly in the share price. And then you have strong efficiency, which is supposedly fully efficient, which is where all public and private information is reflected in the stock price, and it's fairly immediate. And when we say private information, we don't mean insider trading. This is essentially getting more into the kind of technical side, where you have insiders that own shares, and they'll be buying and selling. On the kind of technical analyst side, price action never lies. So the price action will kind of reflect everything known about the entity. I personally think it's kind of semi-strong. If news comes out that one of Apple's factories blows up and the share price goes down 10%, that's just purely the effect of supply and demand impacting the share price. So that's kind of the efficiency gist there. And if we pull it back to what I was previously discussing, the market-based measures, I don't really like assuming that the market is pricing things correctly, because markets tend to overreact in both polarizing instances where investors are panicked, or also when they're bullish as well. So you saw in March, Apple, well, maybe not Apple, because I can't be bothered kind of sorting the price for the stock split in my head, so I'll choose Square. So Square in March was trading for about $36 per share, which was definitely undervalued, and it was kind of overzealous selling during March in the panic. And now you have it only a few months later, where it's the price of maybe 140 to 150, and that's, again, probably not reflective of the fair value of the company. But then I would classify Square as a growth company. But in saying that, over a 3-4 month period, the company has multiplied many times over its share price that it had in March. So assuming that the market is efficient at pricing is a flaw.
Mm-hmm.
So, continue.
Yeah, so what I find interesting there is that I'm of the school of thought, indeed, more like that there's not insiders information, but that I, as a retail investor, have a lack of access to information just by not being dedicated to the information, let's say. Secondly, I also always believe that, to your point, that a lot is due to index investing. A lot got automated. So if you then look at the individual stock, if they are part of a huge index and everyone is purchasing the index, is then the valuation still rational for the individual stock, right? And it can be also suppressed by that. And I give you an example with Ahold, which is not a growth company, but it's a supermarket chain based in the Netherlands and has a presence in the US. When Amazon said we are going to buy Whole Foods, like anything that was considered in that sector was largely sold off. So for me, this was like, you could argue that the market is efficient because it takes that information into consideration. But I had a feeling it was more also due to index selling and such.
Mm-hmm. Yeah. That's a good point.
Yeah. Okay, so I guess that when EMF and I are usually talking around growth, I think it's really around those companies that you mentioned, like Square, Zoom, the hot stocks that are dominating the news continuously. And I found it really interesting that you gave several examples. So I can tell you what is really difficult for me. I see indeed no earnings. Let's say I see losses. So for instance, let's take Zoom as an example. For me, Zoom is a company that is now competing with the old days Skype and such and Hangouts, and I see it entering also in our corporate. And then I think, like, what is really the moat? Yeah, of Zoom and such. So and then I start thinking, okay, how can I value such a company? I have no clue how their hockey stick should look like if we think about it like that. And I was just wondering, like, and it doesn't need to be Zoom, but do you have an example of such a company where I can only see investment and debt, therefore, or such? So I find it really hard to think, like, okay, so what should I pay for such a company? Because I use typically like Benjamin Graham kind of investment style, right? So it's really hard for me.
So something that's good to touch upon in terms of the valuation, and it relates back to that kind of life cycle of the company as well. When you have mature companies, kind of doesn't have to be a big, large cap blue stock, but they have a lot of operating history. They're not growing at 20, 50% every year. Typically, when you have mature companies, which more often than not pay dividends, which may be more of the company, maybe you're more inclined to kind of study, they are typically valued on existing assets. So the assets they have within the company, what kind of rate of return do they get on those assets? How are management allocating, the value of those assets over time? What are they producing? What are the cash flows from those assets? So it's kind of, I wouldn't say easier, but it's a bit more intuitive to kind of derive some kind of arbitrary value, because you can more easily predict the future cash flows. Whereas one thing that a lot of newer investors kind of forget about growth companies is that they are not valued on existing assets, because if you were to value a growth company based on their existing assets, it's harder to understand kind of where the valuation comes from. They're typically valued on their growth assets. And by growth assets in accounting, that's typically assets that they are going to purchase. So you're kind of thinking about 5 years out, and you're not really looking at like right now, what are their fixed assets doing? What are they returning? It's more so putting a price on what you think the growth assets are going to be valued at in 2, 3, 4, 5 years time. Related to your example with Zoom, I'm not super familiar with Zoom. Obviously, I use it mostly every day, but as a company, I've never really spent too much time analyzing them. But I also share that opinion, probably because I've not studied them too much, but I don't really understand them out there. I don't really understand the valuation. But just from looking at a point of view of, I'm just seeing the product and I'm seeing the valuation, and I know that they don't have earnings, I think, if I'm correct. They don't make, so it's hard to kind of gauge why they're valued so highly. But then people who do understand the company and have probably put in a lot more work have probably mapped out, future opportunities that are going to be coming in, what those future opportunities could bring into the company based on TAM. Zoom is a really great product, but it probably also has many more applications than most people could even fathom right now. But then in saying that, is the valuation correct? I'm not sure. But one thing that has stuck in my mind, and I quote tweeted, I can't remember the chap's name, but he made a good point about it, and it's about equity risk premiums. So kind of in the analyst field, if you're more inclined to do, discounted cash flows, which I'm familiar with, comfortable with, but it's not something I really like doing too much with growth companies, and I'll get into that in one sec. But essentially, in a lot of kind of formulas and models used in the analysis of future cash flows, the equity risk premium is one of the components of the formula. And this essentially shows you the expected return over the risk-free rate that you can expect from investing in the company. And the risk-free rate, which is part of the equation, is typically pinned on some kind of risk-free asset, quote unquote risk-free. And these tend to be government assets. So in the US, this would probably be US T-bills. And if you look at the price of US T-bills since the start of the year, they've tanked. So the risk-free rate has dropped significantly. So the future cash flows that are being discounted less. So they're worth more today, which is kind of why I think the valuations have went a bit skew-if, to use that phrase. An advocate of stating that I'm a pupil, I'm still learning. This is my first bear market. I've been in like correction, but a proper bear market is the first time I've experienced it. I've never experienced kind of stimulus to this level either across all the different countries, especially in the US. So it's interesting to see where that'll go. I'm not really on either side as to whether this is going to create an asset bubble or whether this is something else, but I'm always just going to be kind of trying to understand it from my own perspective and what I know. So I can understand why the valuations are high, but I don't really think that justifies the high valuations. Ben Graham, everyone knows the quote, short run voting machine, long run weighing machine. I think in the long run, the market will always price something out pretty accurately. But in the short run, it's anyone's game.
Yeah. So investment talk. So I typically use discounted cash flow, and I get what you mean also because it affects the weighted average cost of capital, right? And I also have a feeling, based on my own research, that heavy loaded debt companies benefit more from it because cash rich companies they get a higher discount rate naturally or higher beta, yeah, specifically they're growing high, so that also gets kind of a skewed. Anyway, what I wanted to ask you is when you're evaluating then a growth company, for me it sounds a lot then it comes to confidence in their business model and in their capacity to innovate and grow market share as an example, right? And get the revenue. So what would you like to see typically in a growth company to build your confidence
Sure.
in the company?
Yeah, so before I answer that, I think it's a really good point, and you identified that correctly. Like my style of analyzing a mature company, typically, I think discounted cash flow analysis is really good, even if you don't kind of take the output as a kind of, given this is what the price should be. It's a good exercise to follow consistently. I typically will do that with more mature companies. With growth companies, I don't even really attempt it because I have no idea, what the revenue growth rate is going to be in 2-3 years for a company like CrowdStrike. It's good right now, but as companies grow in size from that kind of small size, it becomes harder to then, grow 100% the next year, and it continues like that year on year. So kind of predicting that growth rate is pretty difficult. So for growth companies, the value I assign and the kind of what I want to see, there's a few different things. So a lot of people talk about founder-led companies, and this is more of a kind of intuitive goal that I would like to see in the company. It's not a big one for me, but I always like it if the founder is still in the company or even still leading the company, because they know where they want the business to go. They know the business inside out. And the conference calls, if you listen to those as well, you can really kind of get that. I was listening to the CrowdStrike one yesterday, and that was really great. Other than that, you want to kind of see what the total addressable market is as well. I don't, again, pay too much attention to that. If the TAM projection is coming from the company, I tend to put a lot less weight on it because it's quite obvious that the company is going to think that TAM is a lot bigger than it might actually be. So I'm always interested in understanding what they think it will be, but I don't really, I take it with a bit of salt. If it's coming from, an unbiased analyst or kind of industry analyst, I'll maybe give it a bit more weight. You want to see kind of what applications the company has right now and what they could have in the future. So optionality. So CrowdStrike's an interesting one. They do a lot end-to-end point security. But what else could they do? In the conference call, they were talking about the applications for mobile phones, which is a big one. That it's not without reason that you could suggest that CrowdStrike could go into kind of the field where they work with Apple, corporations, not specifically in a corporate level where you sign with company X and all of their security is done by CrowdStrike. It could just be on an independent level where you subscribe to CrowdStrike. That's just going off the top of my head. But you have to kind of think about what future applications that their products could have, who might use those, what's the kind of, I wouldn't say class, but like what kind of grouping of consumers is going to be using that product most often. If you looked at Zoom a few years ago, you might think it's just for kind of corporate use. But so many people since lockdown just pay the $10 or $15 a month and just use it to communicate with family and use it to communicate with friends, despite having that ability on their iPhone with FaceTime. So it's an interesting one and one that maybe people didn't consider. Other than that, for growth companies, I like a really rock solid balance sheet. Early stage growth companies typically don't have a lot of debt anyway. As a rule of thumb, Some do, some don't, but on the aggregate level, they don't really use debt as heavily as your larger kind of like AT&T, for example, anything in the telecoms industry. So a clean balance sheet, basically, I want an excess of cash over all their obligations, maybe in the current year and also long term. And quite a few of the ones that I have positions in, CrowdStrike, for example, they have enough cash to pay off all their obligations. That's before we even look at the rest of the current assets. So the balance sheet is something that I like to be rock solid. Typically, a history of raising equity is not something like diluting the share ownership is not something that I'm super excited about. And then when you get to the cash flows, I like to have not too high a level coming from financing. The investing side and cash flow side is typically pretty messy for growth companies. So the cash flows, I do like free cash flow, but also you have to remember these companies are reinvesting in their business pretty heavily. So the amount of free cash flow that they might have is really important. For anyone listening that doesn't know, free cash flow is just typically the cash that they get from operations. And then we remove capital expenditure, and the amount that they have left is what they can, in theory, use to pay down debt. If they have debt, they could pay a dividend, which I don't see most growth companies doing. They could also keep it as cash, or they could reinvest it in the business. And that's typically what most growth companies do because they want to pour lighter fluid on that growth rate. Free cash flow is a really useful metric for mature companies as well. So typically, the operations and the free cash flow is something that I want to look good. The financing and investing side of the cash flow statement is not something that I put that much weight on as opposed to the operational side. And then when we get to the income statement, growth is always good. You kind of have to dissect that growth as well. Because the income statement is obviously accrual based and it doesn't show, how much cash they're getting and how much cash they're sending out. It's really just what they've recorded in terms of sales. So companies like Square, for example, their Q2 report was interesting to me because the growth was really quite outstanding, but most of that was driven by Bitcoin revenue. So for anyone that is not familiar with Square, they have a few different kind of things they do. They have the Cash App, they have the kind of solution for small, medium enterprises. And within the Cash App, they also have the ability to kind of buy and sell Bitcoin. And that drives a lot of growth in terms of their revenue, but it's a 1 to 2% margin product. So even though revenues went up, I can't remember the exact figure, just say 50%, most of that was Bitcoin revenue. So when you filter it down to the bottom line, only 1% of that comes out. And if you compare Q2 this year to Q2 last year and remove the effects of Bitcoin on both quarters, the growth was pretty much flat, which was kind of interpreted in a way like, Square aren't growing. And I can see that. But for myself, I was under the understanding that whilst I don't really care about the Bitcoin revenue, it's interesting. And that may go with your kind of ideology on Bitcoin as well. But I don't really care about it or really attribute too much weight to it. But I do understand that Square, whilst they are a growth company, they also have a lot of exposure to these small and medium enterprises. And if you look on a more granular level, you can see that a lot more of those small and medium enterprises during the corona were actually switching from mainly using Square as a cash product to going online. And that was something that was beneficial for them. The growth being flat, I wasn't so fussed, to be honest, because they have went through a hard time and they do have a lot of exposure to small, medium enterprises. So for the growth to be flat and not negative, was okay. I don't expect a company to grow 50 to 100% revenues year on year every year. But in terms of the Bitcoin, I think it can only be a positive, although it might not eventually be such a huge part of the company, or if Bitcoin does well, it might be a large part of the company. I don't know, but it's small margin, so I don't really care about it. But the one thing I do know is that it pulls people into the Cash App. And obviously there are other uses for the Cash App. They're now supporting lending to businesses. You can effectively use it as a bank account if you're unbanked, which I think is quite a big problem in the US, as opposed to here in the UK. So, it's attracting people into using their product. So yeah.
Cool. So once you've built up confidence in a company and they have a clean balance sheet and you're happy to invest in them, what's your exit strategy? Like when do you decide to get out of that company? Because that's something I believe I struggle with psychologically. I could see a company growing and growing and growing, and I would probably have a case of FOMO. When do I get out? If I get out too early, do I miss out on future gains? So what typically is your strategy around that?
So I like to look at the aggregate level of the portfolio in terms of weighting. So I have sold a few growth positions this year. I don't like the notion of quote unquote taking profits. That's not something that I'll typically do. But there are a few hard and fast rules that I will typically follow and sell fairly quickly if something like that happens. And I could provide a few examples of instances where that's happened this year. And because we're talking about growth companies, I'll kind of weight it towards growth companies, but also say that with more mature companies, I am typically a hold long-term kind of investor. Starbucks have had a horrendous year. I'm not thinking about selling. The share price has kind of recovered, but my cost basis is pretty low, having held them for 2 or 3 years now. So with mature companies, it's a bit easier not to sell. But then for growth companies, it's more of a mentality thing and it's more of a waiting thing. So I typically hold, in my pinned tweet, it says 65%, 35%. This was before March, or around about that time. During March and April, I saw that kind of growth companies that have cash flows that are not really impacted by Corona, the share price is not getting hit as much. So during March and April, I decided if there is a recovery, it's likely that these will lead the recovery, these kind of companies. So I added quite a lot of exposure to those at that point, more so than I used to. So then it was about 60-40 at that point. And then during the kind of depths, I seen the opportunity at MGM Resorts, the casino company, and I put about 10% into there as well. I typically don't buy deeper value, but the opportunity, which we can maybe discuss later, was there. So I wanted to make an allocation for it. So in terms of selling, as I said, it's kind of a mentality thing and it's kind of a waiting thing. So last month, or maybe 2 months ago now, I actually trimmed half of my Square and CrowdStrike position. And that's because since the kind of original purchases around April, the aggregate weighting of growth companies had grown from 35% to closer to 45% in my portfolio, which is cool. I like letting companies kind of, dominate the portfolio if they want and kind of grow on their own. But at the same time, I don't want 45% of my portfolio to be exposed to these growth names. So I had to trim them back, and it's basically kind of a regimented action. It's not like I didn't want to get into thinking, oh, but what if CrowdStrike and Square go up another 30%, which they pretty much did from the point that I sold. It's more of a point where I have to trim. Which companies do I feel like I can trim? So I trimmed Square and CrowdStrike down by half. I eventually ended up selling Livongo, which was quite unfortunate. So basically I trimmed those two positions, and then maybe a week or two later, Livongo announced a merger with Teladoc. And that kind of broke one of my rules that allowed me to sell. So the original thesis for me investing in Livongo was now broken. I do think that company will be great. I just wasn't interested in it personally. I was interested in Livongo because it was hyper growth, still had a long runway, but with Teladoc kind of connecting with it, that would slow down. So without letting any emotion overrule it, this has broke my thesis. I'm not super comfortable with the merger, so get out. So I sold. If I'd known about that before selling Square and CrowdStrike, I probably would have kept those two as being, I wouldn't have cut them down by half, because by getting rid of Livongo, I then removed my exposure to growth by about 3 to 5%. So it's more of a waiting thing for me. On an individual level, if any of my kind of rules for selling are broken, there's weird stuff going on in management. There's something that happens, maybe an acquisition that I don't like, or a merger, really terrible operating results, or they've sold an asset that's, a big component of the business. If any of these are kind of hit, then I will sell without kind of mulling on it too much. But for the most part, I will only really trim when it's a weighting issue. If growth continued to keep going up and it became 50% of my portfolio in 2 months' time, I would trim back positions again. One of the incentives for selling Livongo also came in the fact that I held primarily 3 kind of large weights to growth companies, but I wanted to diversify that a little bit more. Whilst they're really exciting companies, I'm aware that the earnings, they're not there. CrowdStrike has free cash flow, but the other 2 typically don't on a US GAAP level. So I wanted to kind of divest and buy some other companies. So I picked up some Peloton, a small cap, Red Violet. That way I still have the same weighting of exposure to kind of growth names, but it's spread out across a few different companies.
Yeah, so your mentality, I suppose, is probably something that, or discipline, more likely, is something that is more needed in growth investing. And for me, it's probably something I may struggle with. I know that in my time before I tried trading and I've been involved in Bitcoin, and I've always struggled with that. And that's why I suppose dividend investing is pulled me in. It's a little bit more clear cut and easier for me to make a decision to sell. So, I mean, kudos to you. You're able to do it, but it's something that I would probably have to work on. But for any new investors out there or anyone that's looking to get into this, do you have advice on how they start? And I mean, what would be the best way to start in this form of investing?
I think I would have to give kind of a cheesy answer and just say with any form of investing, you really need to understand a few things. I always just say basic accounting. You don't need it. Like if you're trading based on technicals, you literally don't need any understanding of the fundamentals. You're just looking at price action. I'm not super big on technical analysis. I use some of the indicators to kind of gauge market sentiment, but I don't often actively use any of them to invest. But fundamental analysis, for anyone that doesn't know, is just typically understanding the business from a kind of bottom up. You want to understand how they're making money, if they're making money efficiently, how liquid they are as a company, how solvent they are as a company, and what kind of cash flows are they generating. And it's really not super difficult to kind of understand how to read the 3 income statements and just get a feel for some basic accounting. There's a lot of great books that do that. How to interpret financial statements, same title, one written by Mary Buffett and one written by Benjamin Graham himself. They're great little books to pick up if you're really unsure. So I would say kind of try and understand a little bit of basic accounting. Try read through some 10Qs and 10Ks, quarterly and annual reports, just to kind of gauge like what they're like and just get familiar with seeing them and kind of try and understand what's going on there. But growth investing specifically, it's tough. I think it's like when you first start investing, everyone is more or less pulled to kind of value intuitively because it makes more sense. I don't know if it's that or just because there's maybe a lot more books related to it, but look, everyone loves to read Benjamin Graham. I personally loved it because it made sense, like it clicked, He was saying, if you can buy dollars for 70 cents and then just wait until they're worth $1 again and sell them, or the cigar butt method or whatever you want to call it, that makes sense. But then growth is it makes less sense. And I feel like there's a lot of misunderstanding or misinterpretation, especially on money Twitter, where some people might have started investing in March this year. They've picked up all the saucy names like CrowdStrike and Livongo, and they've seen their returns go into triple digits within 2-3 months. I don't personally think people are like so ignorant to think that that's what the market's always like, but they might not get that sense of delayed gratification that they should probably understand, because it might lead to issues further down the line. Say the economy magically becomes stabilized and the market just doesn't correct in any way, it just kind of grows 5% per year over the next 5 years. They might look at the period when they started investing and become bored with that and maybe try to become a bit more active in investing. And then that typically leads to poorer results. So I think, yeah, exactly. I would just say, take some time. Like if you're completely brand new, I actually had someone message me today, like 5 minutes before we start this podcast, with a screenshot of 3 different types of accounts. He'd set up a brokerage account, and one was for CFDs, one was an ISA, and one was a general account. And he said, which one should I use to invest? And I was like, well, do you know what each of these are? And he was like, no. So I was like, well, why are you about to start investing if you don't know what a CFD is or what an ISA is? So an ISA in the UK, understandably, might not be so well translated outside of the UK, but it's effectively like a tax shielded account. I think it's similar to, in America, I can't remember what it's called, an IRA.
Yes.
IRA, yeah.
It's similar to that. CFD account is like a derivative account, basically similar to options in that you can use margin to buy into a position without having to pay for the full share price. This guy was just asking me, which one should I do? And I actually know someone that used the brokerage before and bought shares of Airbus using a CFD account and messaged me being like, what's happening? I was like, you've bought a CFD. So it kind of scares me sometimes when people are so ready to just chuck money into the market without even understanding what brokerage account they're using. So even if you have a big pile of cash and you want to invest it, I would personally invest passively for a while. I'd probably use indexes and ETFs just to get exposure. I'd probably put the majority of my money into ETFs and then a tiny amount into individual stocks, even if I don't understand how to value them, because you still get that emotional education that comes from a stock price falling and rising. Having skin in the game is important, but understanding the business is far more important, because blips on a screen every day mean little. You should really be like extrapolating it out and looking at every year. So to boil it down to one answer, just read, educate yourself, try to get a good understanding of how businesses work and how to read accounting statements.
Yeah, education is key. And you mentioned a couple of nice books there, but you were quite modest and left out your own ebook. I know you have broken down how to read the financial statements, and I've read it and it's great. So that's another one for listeners to check. But I mean, it's hard for guys and they're on Twitter maybe or on the internet, and they're seeing accounts like you or like others that are posting big results, and I get it, they just want to get involved, they want to make that money. But I suppose you need to take a step back sometimes and realize that this is your money, this is your nest egg, and you have to educate yourself first and not kind of dive right in. I mean, thanks a million for that. We could go on, I'd say, for another couple of hours easy. There's so many other questions that we have and we'd like to ask, but we try to keep these under an hour, so we'll move on to our next section if that's okay.
That's fine.
And we have some listeners' questions here, so I maybe might ask the questions and you two guys might give your thoughts on them. So the Dividend Dane asked, it's around the payout dates. Do you consider these, for example, ABV, Royal Dutch Shell and O, so to make up a range of when you get paid out every month? Is that something that you really think about? EGI, I'll let you go first.
Okay. So yes, I do. Let's say like that. I do analyze my portfolio about having regular dividend payments, but that's more thinking already about my financial independence pay dates, let's say. So actually, I don't actively invest for it, but it so happens to be that if I have a desired portfolio of 40 stocks, that it's quite evenly distributed. I think June is my weakest month typically, but I'm also living frugal. I can manage my money. So for me, it's more important to have it on a quarterly basis coming in, because I can manage 3 months of money. Yeah. So it so happens to be that my portfolio has a relatively good distribution, and I do look at it, but I don't invest for it. I just try to have that mindset of, can I live on it later? Yes or no?
Very good. Same question to you in Investment Talk.
I would say I agree for sure with DGI. I don't ever like to make it a fact. If I'm choosing between 2 dividend paying companies, I don't want to ever boil it down to, well, this one pays in February and I'm lacking in February in dividends. But it's something that I consider, yeah. For me, still being fairly young, relatively smaller portfolio size perhaps, the dividends are not like life-changing for me just now. I'm still in the stage where I want to kind of accumulate larger positions into dividend-paying companies so that, in 10, 20, 30 years' time, the amounts I'm getting every quarter or month are substantial. And I'll do this through individual companies, but I also have a separate portfolio just purely for ETFs, with the same reason. It's a tax shielded account, pays dividends, with the hope that in X number of years, it will be substantial. The passive portfolio, coincidentally, just pays once a quarter, but each 3 of the positions that I currently hold all pay on the same day, so that's terrible distribution. Yeah, I don't factor it in too much. I do see some people tweeting interesting tweets, like if you want to get paid every month, buy a Pepsi and whatever, which is cool. But I think having that as your kind of primary incentive might not be the greatest place to start. But if you're talking about distribution in later life, then I think it's definitely something to consider. But don't make it the kind of the nail in the hammer, not the drive home point.
Yeah, I agree. It's something that I don't pay any attention to right now. I'm like you. I'm young. I'm in the accumulation phase. So maybe when I start getting close to where the dividends are substantial enough to support me passively, I may then reconsider. But at the moment, it's not on my mind. So good question. Thanks a million, Dividend Dane. So the second question we had is from the Sunday Investor, and himself and @BearsWolf had a little chat on Twitter just before we came on. But the question was, what do you value more for growth stocks, revenue or earnings growth?
Me? Okay.
Yeah, either.
That's a good question. Typically for kind of growth companies, the earnings are pretty bad, mostly in the negative if they're in the earlier stage of growth. If you can see kind of a trend, an upward trend where the margins are kind of benefiting the earnings. So for some companies like CrowdStrike, a couple of years ago, the gross margin was closer to 50%, and now it's closer to 73%. So if you can see that trend growing as well as earnings growing, I'd say that's equally important as revenue growing, because you want the kind of the number of customers in the addressable market to be growing and their market share to be growing, but you also want their margins to be quite good. In like SaaS companies, the actual benchmark is about 75%. 70 to 75% is the kind of good range for that. And gross margin on an accounting term, everything below the gross margin line is used to pay for expenses of the operations, and then some other items like tax and interest. But if the fatter your gross margin is, the more kind of cash you have to kind of pay for expenses, and then that will eventually bring up your earnings as well. So for me, I'd hold them both in equal regard.
Maybe is my understanding well that with such companies, they probably have a certain amount of fixed cost, and for every incremental revenue, we want the costs to be really low, right? So we're looking at incremental costs lower than the sales it brings in. Yeah,
that's a good point. There's one smaller cap company that I invest in. They're taking like advantage of big data. I don't know if you're familiar with Red Violet. That's so basically, they buy huge quantities of data and then they kind of disaggregate it and analyze it and kind of sell that information to other companies. It's kind of Big Brother-esque, but they pay a fixed cost for their data. So any kind of new customer or sale they get on top of that goes directly into the gross margin. So that's getting fatter as time passes on. So to your point, that's exactly what I'm looking for.
Yeah. Okay, cool.
And then the last question we have is from Phil. He asked, if you had to choose, would it be large cap, robust, but like a slow tank ship, or small cap, more transparent and a flexible speedboat?
That's a good question. I would probably choose larger cap. In my mind, they're probably more transparent because, again, they're valued on their current assets, whereas a small cap is valued on, if you're talking really early stage small cap, it's not even valued on growth assets, just valued on kind of future projections. And then when they go from being kind of startup idea to growth stage, then they're kind of valued on growth assets. I'd say smaller caps for me personally, because that's not a space where I'm like super experienced, is less transparent. You know, you have a whole host of other issues, you know, shady shareholders and stuff like that. So I would choose large cap.
EDGI.
Looking at my current portfolio, I would actually probably choose more a small cap just for diversification, because I've got only large caps actually. And yeah, it's really diversification driven answer. So
I would probably go large cap, and like you, they make up most of my portfolio, but it's where I'm most comfortable. Great.
Cool. That brings us to the end of the listeners' questions section. Thank you all. But now, what we always say, our favorite topic of the week. So maybe let's ask our guests first. So, Investor Talk. Do you have either like your most favorite stock or a stock pick? I guess your most favorite stock in this case, which you would like to share with us.
So we obviously discussed this a little before the show, and I was unfortunately I don't really have a stock pick right now, because currently, like in my watch list and my own portfolio, there's not really anything I'm looking to add to, or there's not really anything that's like jumping out at me and that I really want to pick up just now. I do have a little cash in the portfolio, but I'm not in a rush to use it. Obviously, the last end of the week has been pretty dramatic. If you're largely exposed to growth companies, didn't impact me so much, obviously because they're a smaller weighting in my portfolio. So I figured I would answer this question essentially as though we were talking 2 months ago. A few months ago, I was really, really bullish on MGM Resorts and MGP, MGM Growth Properties, which is the kind of subsidiary, which is a REIT, REIT. And for those that don't know, that's just a real estate investment trust. MGM was screaming at me as a really good value play. And I'm typically not someone that buys value. But this was kind of like a depressed asset that had been taking on a lot of negative investor sentiment. Back in kind of April, if you look at the price to book and the price to sales, you were paying 70 cents per dollar of revenues, and you were paying about 75 cents per dollar of book value, which in very classic terms, you're paying cents for dollars. I think it's fair to use these metrics on MGM just because they're kind of more mature. But you have to also note that in the following, I think in Q1, casino industry revenues were down maybe 97%. And then in Q2, can't remember the exact figure, but I think even as much as last month, they were down still 35%, which is pretty bad. But the average 5-year mean of MGM's book value when I was looking at it was about 2.3. And then there you had it at 0.75, and then the price to sales was pretty similar. It was about typically investors over a 5-year average would pay $1.40 per every dollar in MGM's revenue, and then you had back in April people were paying 70 cents. So I was like, this seems like a fair opportunity to me. I looked at the balance sheet, very strong. They had excesses of cash, very liquid. They could technically, if you looked at their cash burn rate, go for 2 years without having any income and still, be a going concern. And for anyone that doesn't know, just to clarify, a going concern is typically an accounting term just for a company that is expected to, still be alive into the future. I think the actual term is indefinitely, but that's just something to say. So MGM was really interesting. I picked up a 5 or 6% weighting over 2 different lots in them, and then subsequently over the next kind of few weeks, IAC, quite a large investment firm, picked up a 12% position in MGM, and I read the shareholder letter there, and they were just talking about the kind of online gambling kind of push and how MGM are in there. For a lot of UK listeners and maybe EU as well, the kind of craze over US online gambling might seem a bit strange, because in the UK anyway, it's quite a huge part of the culture, especially sports betting, ACCAs and people betting on the football at the weekend. But in the US, that was largely illegal for a number of years, and only recently was made legal in quite a lot of states. So that's kind of a big boom there. And conversely to the UK, the US, if you are an online bet maker, you can't set up independently. You have to partner and go through a casino. So MGM are kind of benefiting from that right now. They've set up online betting. I think in New Jersey, they're the most popular online betting service. The projected revenues are pretty small, around 300 to 500 million. But it's a good kind of diversification into a new kind of space for MGM. This position is not something that I intend to hold for 10 years, like most of mine. I personally think that they will eventually go back up to the kind of fair value. They cut their dividend in Q1, which obviously would immediately reduce the price just automatically, because of the cash flow coming through would be less. I feel they would eventually reinstate their dividend and might be an attractive, dividend paying position. But I'm undecided on whether I'll keep the position. I do hold the right MGP, which pays quite a handsome yield. I'm planning on holding that for the long term, but MGM, not fully decided yet, but typically if it comes back into the kind of 32 to 35 range, might let that one go and reallocate somewhere else. But even at current prices, I still think MGM, I wouldn't pick up any right now personally, but I think if you're looking closer to the kind of $16 to $18 range is really attractive. But saying that, that's not investment advice, so yeah.
No, don't worry. It's a bit of pep talk here, so we expect our listeners also to make their own wise life decisions. How about you, EMF? Any stock pick from you?
Yeah, I'm going back to one I picked a couple of weeks ago again, which was Walgreens. I have an article on them, which I'll post in the description here. But I really like them. At the moment, the yield is quite high. They're covered by free cash flow. There is some concerns about future earnings, but I believe that they'll be okay. And they have some innovations coming along the way. So that's short and sweet this week, but that's why I'm picking. How about you?
Well, I wanted to actually bring up a utility because last week when we did our podcast about utilities, about our portfolio, our top 5 positions, we were challenged that we didn't have any utilities in there. And I saw that Red Electrica, the Spanish utility, came quite down a little bit. Based on my back of the napkin valuation, I believe it's pretty well valued. I mean, low valued, under 16 euros per share. So I bought it like a few months ago at 15.50. It's now around just below 16. For me, this is an attractive value zone for it. It's a slow growing company, but it has 25 years of dividend growth, and that's quite strong for a European company. Its average dividend growth over the last 10 years was around 7.3%, and it's kind of as clockwork around this. It has a high payout ratio of 82%. So you really need to, in this case, really look closely to their earnings growth, right? Because they don't have any way up anymore in their payout ratios. And you get it today for around 6.5% yield. It's in Spain, so the tax rate is 19%. So you get it for 5.3 adjusted for tax yield, which I think is pretty nice. And it's also one of those companies that doesn't pay once a year, but twice a year. So for people that are interested in that, I think Red Electrica is a company that you could look into if you're interested in adding some more exposure to utilities in your portfolio.
Yeah, they're a nice company. I actually picked up some during the week. I mentioned to you before the show. I had a position in them before as well. I really like them. As you said, the payout ratio is a bit high, but their earnings seem to be growing with it, so I'm not too concerned. No, good choice. So that brings us to the end of the show. Investment Talk. Thanks very much for coming on. I mean, I had loads more questions than it was great chatting to you, a wealth of knowledge, and it was great to have you here. So thanks very much.
Really appreciate that. Pleasure. I feel like we could have chatted for many more hours. I'd always be happy to come back though. It was good fun.
Yeah, we'd be delighted to have you. And to all our listeners, again, thanks a million for listening to us. Check us out on YouTube and Spotify. I've had fun. EDGI, did you? Any last words?
Yeah, definitely. I mean, I've been making notes during the show. So thanks, Investment Talk, because for me, this is a really intriguing topic and I'm a self-learner. I do know quite a little about accounting, but hence why I'm so much struggling with growth companies as well, because I look at the numbers too much, maybe sometimes. I just want to thank you a lot. I think it's you can explain really well, so lots of appreciation there. If you don't follow Investment Talk yet on Twitter, I would recommend to do so. We'll post a link into the description. We'll also post a link to his book that Derek referred to about learning about how to read statements, also in the description. And I guess once we are more advanced as a DGI community, we might ask you back, Investment Talk, to bring us to the next level.
Yeah, I'd be happy to. That's really fun.
Thanks.
Thanks, million, guys. See you next time.
Yes.
See you next time. Thank you.